This video is not about some flashy get rich quick trading strategy. Instead, it is about the real foundation of trading success, discipline, risk management, and trade execution. I know these topics might not seem as exciting as strategy breakdowns, but without them, even the best strategy won't save you. If you truly want to become a consistently profitable trader, watch this till the end. I've selected the topic Path to Trading Success, which is the ultimate goal that each trader is trying to achieve. I'll share some of the things that helped me succeed. So, part of that first item is trading plan. Imagine you are a pilot. You can't just press a button and start the engine and fly the plane. There are a number of things that you need to check before reaching to that stage. Similarly, a trading plan includes all these checks before you hit buy or sell in the financial market. You make a very common mistake. We launch MetaTrader or any other trading platform. We see a big candle going up, and the next thing we do is click on buy. Why? Because we think we'll miss this opportunity if we don't do it. What happens next? This candle retraces, and when we see we are losing money on this trade, then we close it in a loss, or worse, we stay in this trade with the hope that it will go up and ending up with a bigger loss. If you have a trading plan, then it must include all the rules to successfully execute a trade. So there are different components of a trading plan. So first one is trading session. So you can't just start randomly trading whenever you feel like. As part of your strategy and lifestyle, you need to decide which session works best for you. Is it Asian session, London session, or New York session, or a combination of two sessions? In the world of trading, different sessions represent distinct periods of market activity. The Asian session kicks off the trading day, primarily focusing on currencies like the Japanese yen, AUD, and NZD pairs. As the sun rises in London, the European session takes center stage, influencing major currency pairs like the euro and the British pound. Finally, when New York wakes up, the North American session begins, impacting the US dollar and setting the tone for the day. Understanding these sessions is crucial for traders as each brings unique opportunities and challenges. Whatever you decide, stick to it and only trade during that time, and you'll notice better results. Next item is risk per trade. You can just enter a random lot size when taking trade. You must come up with a plan on how much risk are you willing to take for each trade. Start thinking in terms of percentage and not the dollar amount, and that will help you in the long run when you'll be trading bigger account size. Do not risk more than 1% on a single trade. Like if you can start small, like 0.5%, and then build some equity. After that, you can increase the risk by taking advantage of the equity, but again, do not exceed 2%. Next one is entry. As part of your trading strategy, write down the exact criteria to execute a trade. It has to be a mechanical system. For example, you can say I will enter a buy trade when candle closes above moving average 50. So during your trading, when you see candle closes above the MA50, then without any hesitation, you will execute the trade. Next one is exit. It is very important to define a rule when to exit your trade. Most of the time, as a new trader, we close the trade immaturely while it goes into small profit. As a result, we miss big profits. You can define any strategy like closing the trade when at 2x profit or close the trade when it closes below a certain moving average. Next one is trade management. Just like defining rules for entry and exit, you should know how well to manage the running trade. If you do that, then it will be a lot easier to manage the active trade rather than thinking about different ideas while in the trade. As part of trade management, you can have different rules. For example, you can say close the half trade when it is in 1x profit and move the SL to break even. Another way could be to add a new position when your trade is in 2x profit and move the SL to 1x. There are a number of ways you can come up with the rules, but main point is to define these things ahead of time. Next thing we'll talk about is when to end your trading day. It is very important to define it as part of your plan.
because we don't want to sit in front of your computer all day and take trades. You need to clearly define if you hit certain percentage of profit or loss, then you will stop trading for the day. For example, you can say you'll stop trading after losing 2% of your capital. Similarly, you can also define to stop trading after winning 2 trades or reaching 2% profit. Celebrate your successes or learn from your losses. It's all part of the trading journey. In the next slide, we'll cover the topic of trading discipline. So part of trading discipline, I have broken into different components. So first one is stick to your trading plan. You're responsible for your own actions. No one is watching you when you are taking trades. So you need to make sure that you stick to your trading rules. If you violate those rules, then there is no point of creating those rules, and it will be an endless cycle of wasting time and money. Next one is stop searching for the holy grail. This is a very common issue where we keep searching for the best strategy that can offer 90 to 100% win rate. We start with one strategy, it works for a few days, and due to the change in market conditions or any other reasons, when it stops working for a day or two, then we start looking for a new strategy. You need to initially spend some time to define your trading strategy. Spend a lot of time in back testing and then forward testing, and then you will know how good is the strategy. You have to know the win rate of the strategy, so you will know that you may get number of losses before becoming profitable again. If you do this, then you'll be confident on your strategy. As part of trading discipline, next item I have chosen is maintain emotional control. Maintaining emotional control while trading is crucial for success. This is one of the biggest issues that causes us to lose money. We are humans, so we'll always have emotions, especially when dealing with money. There are different ways to handle it. Firstly, set clear, realistic goals and adhere to a well-defined trading plan to guide your decisions. Secondly, practice mindfulness techniques such as deep breathing to stay calm and focused, especially during market fluctuations. Thirdly, embrace a disciplined approach by sticking to predetermined risk limits and avoiding impulsive actions. Another important component part of trading discipline is trading journal. A trading journal is like a diary where traders write down their experiences in the financial market. It is important because firstly, it helps you remember and learn from your past trades, both the good and not so good ones. Secondly, it allows you to see pattern in your behavior, helping you understand what works and what does not. Thirdly, it serves as a roadmap for improvement, helping you make better decisions in the future. Fourthly, it promotes discipline by holding you accountable to your trading plan. Lastly, it is a valuable tool for building confidence and staying organized in your trading journey. And in the last slide, I have selected the topic of embracing risk management. And imagine you are playing a game, and in the game, you have to make choices. Now, think of trading like playing a money game where you buy and sell things to make more money. Embracing risk management is like being smart about the choices you make to protect the money you have. So there are different components, part of like a risk management. The first one is preserving capital. Just like you would not risk all your game points on one move, in trading you decide how much of your money to use for each trade. It's like having rules for your game. In trading, you set rules to limit how much money you could lose on a trade. It's like saying, I won't lose more than this amount. Next one is setting stop loss. Always use a stop loss when trading. Are you willing to drive a car with failed brakes? No, right? Then why are you willing to trade without using a stop loss? Trading is a game of probability. You can take best setup and follow all your rules, but it doesn't mean that this trade will work out. It may go in your favor initially, but it can reverse quickly. And so you lose the trade, and that's why it is important to set a stop loss to preserve your capital for next trade. Next one is risk to reward ratio. Risk to reward ratio is a measure that compares the potential profit of a trade to the potential loss. It is expressed as a ratio such as 2 to 1, indicating that the potential reward is twice the potential risk. Let's say if you take 1% risk, in this case we can assume $100 risk, then you always have to take those setups that offer profit higher than 1 to 1, preferably 2 to 1. So if we're taking $100 risk, then we'll only take those setups that offer $150 to $200 profit. By using this approach, even if you lose 50% of trades, then at the end you'll still be profitable. Thanks so much for watching. If you found value in this video, give it a thumbs up, hit subscribe, and share with fellow traders. Your support keeps this community blooming. Wishing you profitable trades and positive vibes. Until next time, happy trading.